bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the March 31st, 2026 episode. I'm here today with my partner, Tony Grappone. Tony works closely, as our regular listeners and viewers know, with renewable energy developers, sponsors, and investors, and he's been providing accounting and consulting services to the renewable energy industry for over 15 years. Now, in today's episode, we're going to take a forward-looking view of the renewable energy tax credit marketplace, taking that view as we're closing out the first quarter of 2026. We're going to discuss what developers and investors are prioritizing this year, and we're going to provide a first quarter perspective on overall market conditions, as well as examine how capital preferences by investors are influencing project strategy and structuring by developers. Now, there are several key themes that will run through the course of our discussion today. One is the evolving investor demand for tax credit transfers, for tax equity, and for cash equity. Another is the increasing investor demand for already in place existing cash flowing energy facilities, as well as the increasing demand for energy that's being driven by the increasing development of data centers, thanks in large measure to AI. We're also going to discuss the continued effect of compliance considerations. Heartache, I think many are thinking, it's not just compliance considerations, particularly related to foreign entities of concern or FEOC. As you can hear and see, we have a lot to discuss today. So if you're ready, let's get started. Tony, thank you for joining me today on Tax Credit Tuesday. You're here today as a guest, as opposed to the host. I appreciate you guest hosting when I can't make the podcast, so thank you for that. And this is your 34th appearance as either a featured guest or as a guest host.
Thank you very much, Mike. And it's been a few months since I've been on the podcast as just a guest and not a guest host. So I'm excited to be back here with you answering questions as opposed to asking them.
Great. Thank you for that. Now, many members of our audience have met you at one of the conferences, or they've turned into previous podcast appearances, or they've seen you speaking at one of our conferences, as I mentioned. But many are first-time listeners or first-time viewers. So for those, please describe to them some of the services you provide to Novogradac conferences. To Novogradac conferences, you already speak at Novogradac conferences, but what you provide to Novogradac clients.
Okay, yeah, great. The podcast has developed a nice following. And so I go to a lot of different events throughout the year or talk to clients throughout the year. I love hearing from clients and industry participants saying that they tune into the podcast regularly. They love the topics that we get into. They find them very helpful. So I really appreciate this platform that we've created to provide helpful updates and information to the industry. So at the firm, in addition to speaking at events, I oversee a few different silos of services. We've got Novogradac's a CPA firm, so I've got a team that specializes in traditional financial statement audit services. I have another silo that focuses on preparing tax returns, and then a third silo that gets more into some of the topics that we're going to discuss today. For example, so it's more of a transaction advisory silo of services where we focus on financial modeling, and then agreed upon procedures engagements, agreed upon procedures to help clients show their compliance profile with things like prevailing wage and apprenticeship criteria, starting construction, domestic content, foreign entity concern, and then there's also repowering renewable energy facilities under what's commonly referred to as the 80-20 rule. And that's actually a service line. We'll touch on that a bit later. You know, in your opening remarks, you talked about some investor interest in assets that have already been placed in service and generated some credits, but now they're just cash flowing and operating. And now you get these older assets that have been operating for quite some time that are well beyond their tax credit period. You're starting to see some of those facilities go through a repowering exercise so that they can qualify for credits again. And so that's another sort of emerging trend we're seeing in the marketplace these days. So yeah, excited to go through our list of topics with today.
No, I look forward to going through the list as well. And later in the episode, as you know, I'll ask you a few questions about the service needs that most of our developer, investor, and sponsor clients have right now. But let's start at a big picture in terms of you might call it a temperature check. We're closing out the first quarter of 2026. So please share with the audience what project or financing trends that you're seeing in the marketplace.
Yeah, great. So first off, like you said, we're closing out Q1. And one thing I just like to say is the industry is in a much better spot today than what it was a year ago at this time. Last year into Q1, a lot of the industry participants were in a wait and see mode. The industry was bracing itself for the tax reconciliation bill that ultimately turned into the One Big Beautiful Bill Act that got passed last July. At the end of Q1 2025, people were going to wait and see mode. They were nervous and just waiting to see what happened with the tax bill. And then you fast forward to today, and I'm happy to say that there's just a lot more optimism in the marketplace. The OB3 got passed. People have had time to start to understand it better and figure out how to work with the rules enough so they can keep projects moving forward. Another thing that's really apparent from talking to developers, lenders, investors, et cetera, is just how many developers were able to start construction on a tremendous volume of projects. And when you talk to developers, they just feel at ease knowing that they've preserved tax credit eligibility on large portions of their pipeline through at least 2029 and some even beyond. So all that has contributed to greater levels of optimism in the marketplace. And so, yeah, so for financing trends, in terms of the trends right now, you're still seeing a lot of traditional tax equity partnership flips as far as structures go. That's still the most common structure you're seeing in the marketplace. It's the traditional partnership flip that has what they call a transfer option built into it. So partnership flip, but where the parties can ultimately decide if they want to elect to transfer the credits as opposed to retain them. That's the kind of your most common structure. You're also seeing, you still see this structure that many people refer to as a prep equity structure, which combines some elements of traditional tax equity, but also implementing more of a cash return profile to an investor. That's picked up some headway. Seeing sale leaseback transactions a fair amount. And then, like we've touched on a little bit here, an evolving trend is around cash equity investors that favor a shorter tenor to their investment timeline, as well as because the tax bill implements new tax rules have to be complied with. I think you're seeing in cash equity investors in the market say, all right, it's going to take a while to maybe understand some of these new tax rules. So maybe what we can do is we can redirect some of our money towards portfolios of assets that have already been placed in service and aren't subject to that sort of more complex tax underwriting exercise. So I think the preference for operating assets is a combination of investors that would like a shorter tenor to their investment timeline, as well as an opportunity to maybe avoid some of the complicated tax underwriting that is stemmed from the OB3.
Got it. So I appreciate the sharing that kind of overview and discussing what investors are thinking about. Let's look at developers. And we have the July deadline rapidly approaching. So I would expect developers are somewhat focused on that. But what else are developers focused on, and or what steps are they taking now with the July deadline rapidly approaching?
Right. So when you mention that July deadline, you're obviously referring to solar and wind developers have until July 4th to start construction on facilities in order to benefit from a longer timeline to get their facilities placed in service. And if they don't start before July, they're stuck with this 2027 cliff date to get their facilities placed in service. So naturally, developers are rushing to start construction, obviously under the physical work of a significant nature standard. For most developers, that's the one opportunity they have to start construction. Transformers have become super popular in that space to start construction. So developers are trying to work with transformer suppliers and any other sort of suppliers of components that are tailored to the facility and not components that are perceived as inventory off-the-shelf components, right? So you get a lot of action going on there. You also have developers that are starting construction this year, and they're trying to navigate, and we'll talk about this later in the episode, but they're trying to obviously navigate the FEOC rules. And so we're talking to a lot of developers who are trying to make sure that they're developing a sound procurement strategy, carefully looking
Right.
at the vendor mix of suppliers and evaluating whether or not they meet the FEOC criteria, et cetera. And then you have developers that are they've got their legacy projects that were placed in service. They're subject to financing commitments and they've got placed in service deadlines under their power purchase agreements. And so they've got to keep those projects moving forward and to get them placed in service and complete the financing. So developers are, I feel like they're as busy as ever on a variety of different fronts.
Thinking of that, I wanted to turn to the demand for energy more generally and the impact that has on the renewable energy market. Maybe just to level set a bit. And this isn't something that I was quite as aware of, but in preparing for the podcast, the surge over the last 5 years was quite notable. And by way of example, the U.S. Energy Information Administration reported earlier this month that U.S. energy or electricity demand between 2005 and 2019 had about a 0.1% annual growth rate. So obviously lots of energy efficiency and other steps being taken to where the annual growth in electricity demand was only 0.1% over that 14, 15-year period. But starting in 2020 through last year, the annual growth was 1.7% a year. To a certain extent, 1.7% doesn't seem like much of a surge, but you do 1.7 over a 5-year period when the previous 14 or 15 years was 0.1%, that's a pretty significant increase in demand. Now that demand, no news breaking item here, is because of data centers and AI optimized servers. And then when you look forward through 2030, it was quite remarkable that S&P Global report that you and I discussed in preparing for the podcast estimates that nearly 76 gigawatts of energy is needed in the US for IT equipment, cooling, lighting, and other uses. 76 gigawatts, but over the next 4 years, that'll nearly double up to 134 gigawatts in 2030. I mean, that is a huge increase in demand. So with that, how is this data center boom influencing the development and investment strategy in the renewable energy space?
Yeah, no, I mean, the deployment of data centers, it's putting stress on the market, on the power sector, and developers are trying to respond to that. Data centers obviously are a driving factor right now, and they're going to continue to drive that for many years to come. And getting through permitting, finding the components, the construction, the labor, there's so many aspects to this process to meet the surging energy demands to come. And it'll be interesting to see how that sort of all develops. But then as part of that, Mike, from talking to developers in the marketplace, they're doing everything they can to meet these power demand needs. Not only do they need to get components to build plants, but they need to get components that are also FEOC compliant. Okay. An additional strain. But then because the owners and operators of these data centers, they're forecasting such strong power needs, they're communicating back to independent power producers like developers of clean energy facilities and saying, look, we need all the solar and battery storage that you can deliver us, but we want even more, right? We want even more. And so part of the more, it's sort of all above the line strategy of what other power sources do you have? And developers are finding to be truly competitive in the marketplace, they also have to think about other forms of power, baseload power. I'm talking about gas-powered turbines, an energy mix that a lot of pure clean energy developers haven't really had to incorporate into their portfolios in the past. I'm telling you, I've talked to a lot of clean energy developers. I'll call them clean energy developers. I think they're just really energy power plant developers going forward. But most of them are working strategies into their mix where they can incorporate solar, battery, all those clean energy technologies, as well as gas-powered turbines. Many of them have already started placing orders on 1 megawatt size gas power turbines that they hope to get. It can take 3 to 4 years at least to get a gas powered turbine, but they're starting to place those orders.
No,
And
that's very
anticipate,
interesting
yeah.
to see the renewable energy developers expanding as they're trying to provide the energy needs for these data centers. So I wanted to also, as we mentioned in the intro, and you can see the pause in my voice, because it's a very critical topic, but one that's fraught with issues. And that, of course, is foreign entities of concern, or FEOC. Now, we've covered FEOC in several past episodes of the podcast. To our audience, most recently, Tony and our partner Josh Morris discussed the new FEOC restrictions in the March 3rd episode just a few weeks ago. And I would encourage any audience members that want more detailed background in FEOC to listen to that and other previous episodes where we covered the basics of FEOC in a lot more detail. Also, Josh Morris did lead the drafting of a Novogradac special report on the new FEOC regime. And if you don't have a copy of that report, you definitely should get access to it. I'll include a link in today's show notes. The special report does also discuss the legislative and policy background of FEOC, as well as providing a comprehensive guide to FEOC compliance, material assistance, and maker implementation. So like I say, I highly recommend you checking it out if you don't have a copy of the report. That said, for the sake of this podcast, and in order to provide a brief overview of FEOC, I'll just note that the One Big Beautiful Bill Act, as Tony noted, signed July 4th of 2025, did implement several restrictions regarding foreign entities of concern and the impact foreign entities of concern's involvement in renewable energy development, construction, and ownership could adversely affect the eligibility for clean energy tax credits. Now, these new FEOC restrictions generally, that's one thing about FEOC, everything has a generally and exceptions and the like, so it's definitely quite arcane, but generally applies to facilities placed in service after 2025, which means that FEOC's a pretty significant consideration, excuse me, for virtually all projects right now. So Tony, you've hinted upon and touched upon FEOC considerations, how they're affecting decisions in 2026. If you could share more about the impact of FEOC right now, I'd appreciate it.
Sure. Yeah. Thanks, Mike. So, yeah, just a quick reminder for folks. When it comes to FEOC, I like to think of that as a three-legged stool. There's three main elements of compliance there. You've got the first leg, I like to think of that as like a PFE designation or prohibited foreign entity designation. And so there's some criteria you have to evaluate to make sure you as the entity that's owning the facility and some of your investors and financing parties aren't a PFE. That's leg one. And then the second leg of the stool is what I like to refer to as effective control. And so on the effective control criteria, that's really looking at payments that you're making under agreements and whether or not those payments that you're making to the counterparty of those agreements, making sure that payment doesn't lead to transferring effective control over to the counterparty to that contract. And for the most part, what we're talking about there is contracts that involve certain type of IP, where the vendor of that IP might be granted effective control over the use of that IP, which could allow them the ability to control the quantity, timing of the power or energy being generated by the facility. So that's the effective control leg of the stool. Third leg of the stool is referred to as the material assistance cost ratio, oftentimes just referred to as maker. And that looks at where did the project buy its components, and did the project buy enough of its components from non-PFEs, and to make sure it didn't buy too many components essentially from China. There's a number of different organizations, countries, et cetera, that are listed on the FEOC list. But at the end of the day, the main target we're really referring to is Chinese component suppliers and companies owned by Chinese investors. And so that
We're
material
not
is
concerned about North Korea or
not,
Russia or
maybe we are, but not necessarily for FEOC compliance reasons. And
I would
so,
just say that I like your breakout into the three stools because I always think of it as ownership by a foreign entity of concern or effective ownership through effective control. So it's like the whole ownership or control aspect of it. And then it's the actual assets themselves in the sense that not surpassing a threshold of portions of the asset coming from foreign entities of concern.
Yeah, that's right. I think it's really helpful for people to keep that in mind that there's three pillars or three legs to that compliance stool. You have to evaluate all three.
Yep.
Back in February, the IRS issued a notice 2026-15. That notice provides helpful clarity around how to comply with the material assistance cost ratio. And so since that notice was issued, we've been working with a lot of developers to try to help them come up with a game plan to meet the material assistance cost ratio analysis. And again, that analysis is all about making sure you're buying components from non-PFEs. And if you have any PFEs in the mix, you want to make sure that the components you buy from PFEs don't exceed a certain threshold. The maker analysis honestly gets the most chatter in the industry. People seem to be the most focused on that. I highlight the fact that there are those two other legs of the stool so that people don't forget about them and neglect them. But the fact that this notice came out recently that provides clarity on the hottest topic in FEOC compliance, which is the maker analysis, is very helpful. And that podcast that Josh and I did was very informative, gave great insights on tips and best practices on how developers can think about mapping out their strategy to comply with FEOC under the maker analysis. And then the special report that Josh was the primary author of on the FEOC regime is the most comprehensive overview I've seen yet on the FEOC rules. It's roughly a 90-page analysis.
Funny that you mentioned the 90 page. I wasn't sure if I should mention the 90 pages because it might scare people away or mention it because it shows how thorough it is. But it does have charts and graphs.
Yeah, it definitely does. And although it's a very comprehensive analysis, I love it because you can jump right in and you can just start searching for keywords and it takes you right to the specific area you want to focus on. And it's also just a very helpful reference material whenever you're needing to quickly find the rules. It organizes the code and the notices and all that stuff. It's super helpful. Yeah. Anyway, long story short, we're working a lot with developers right now, especially trying to help them map out their strategy to comply with the material assistance cost ratio. And that involves things like really closely looking at your vendor mix. Novogradac has a lot of experience helping clients meet the domestic content criteria. And the domestic content criteria is analogous in many ways to the material assistance cost ratio criteria under FEOC. And so we have really developed a nice service line to help clients figure out how to map out a nice procurement strategy to meet domestic content. We're leveraging that platform to help work with not just clients on the project side, but we also work with the vendors, the manufacturers of those components, and we help them organize their information so that when they're being approached by developers, they can help get those developers comfortable quickly that those vendors are actually complying with the FEOC rules as well. If you're a developer and you're looking at this, I think it makes sense to reach out to us so we can help you develop a well thought out strategy.
And obviously the driver or one of the key drivers for the developers and the actual companies themselves, the manufacturers, is the fact that investors need to have assurances and they need to have auditable evidence that the rules are being complied with so they're entitled to the tax credits that they're expecting to get, which is a bit of a segue into the investor side. And in the introduction, I mentioned the tax credit transfer markets. That's one sort of investor subset of the market, if you will, from investors. There's cash equity. And then the third being, or the second being cash equity, the third being tax equity. Mm-hmm. So maybe tax credits, tax equity, cash equity, those three, maybe it's a second three-legged stool.
Three tiers. Three tiers. All right.
Please share with the audience what you're hearing in the market around transfer buyers, around traditional tax equity investors, and around cash equity investors.
Yeah, great. As you can imagine, investors like low risk investments, right? And they like certainty. So as a result, if you're a tax credit transfer buyer, tax credit transfer buyers, a lot of times they don't invest in actual partnerships as owners. They're just coming in on a very transactional basis to buy a credit and go away. And so for that investor pool, we'll call them investors, but they're really just tax credit buyers. They're not as familiar with the nuances of how these facilities operate and all that's involved. And sometimes they like to keep it that way. And so naturally they're thinking they want the absolute lowest risk credits they can get their hands on, because that way they don't have to spend as much time trying to really understand all the nuances of the deal. And so they gravitate towards those transfer buyers. They have shown a tendency to really like production tax credits. Okay, production tax credits, they don't carry the same kind of recapture risk that an ITC carries with it. And so the transfer buyer market has shown a real preference for 45X production and other types of production credits like wind PTCs, et cetera. Traditional tax equity investors, those are investors that they take a real ownership interest in the underlying property and get credits in exchange for that. Those investors, they too like the production tax credits just due to the lower inherent risk factor, but they also are showing a strong preference for ITCs that qualified under the old Section 48 and 45 rules. Okay,
Yep.
so we're not talking about tech neutral credits here. We're talking about the old legacy credits.
Non-FEOC.
The non-FEOC credits, exactly. And so really, when you talk to the investors that are using credits, they're definitely showing a very strong preference on credits that aren't subject to the FEOC requirements and maybe aren't even covered under 48E and 45Y, which are the tech neutral credit provisions. They're really still showing they're paying a premium, they're paying higher for the credits that are either PTCs or credits that are grandfathered under the old tax credit rules. And then as far as cash equity investors go, the cash equity investors, similar, they'd rather focus on, as opposed to looking at a deal that has FEOC compliance matters associated with it, maybe they'd rather look at an 80-20 deal. Maybe they'd rather look at just a regular operating asset portfolio, or maybe they'd rather look at a portfolio that also grandfathered under the old Section 48 and 45 rules. So we do get developers that are coming to us and saying, look, we're trying to understand our FEOC compliance profile, but we need to start construction this year. Can you help us get ready for those due diligence conversations with investors? And investors know that's coming, right? And we like to try to help the industry by coming up with third-party reports that can help developers demonstrate and message to their investors what their compliance profile looks like
Right.
with respect to these various matters.
No, I do like you're pointing out that the transfer buyers are focused on credits with less recapture potential. It's sort of like the efficient market at play, right? If you're doing transfer buyer and you don't want to get too involved in the project and do a lot of due diligence and all the rest, and you want to avoid the risk of recapture, maybe I should be investing in credits where there's no recapture or the recapture risk is a lot lower. And then when you look at traditional tax equity investors, they're getting tax losses. So they're in the deal, they're underwriting the deal, they're focused on what the losses are going to be over the 5-year periods and or longer. And so as a part of all that underwriting, taking on the recapture risk isn't nearly as greater a burden because they have to be fairly knowledgeable to be a tax equity investor. So it's nice to see the efficient market at play here. And then obviously, if there's a higher risk of recapture and you get tax credit insurance and that has a cost associated with it, so you can see the market shaking itself out here.
And so I make it sound kind of simple, right? Like, oh, if you're a tax credit buyer, you like PTCs, just go buy PTCs. It's not that simple, right? Like
Exactly.
there isn't this endless supply of
That's
PTC
right. That's right.
transactions in the
That's right.
marketplace. Wouldn't that be great? And that comment also makes the assumption that all investors are equal, and they're really not.
That's right.
And part of the analysis involves what are their return requirements? Okay, what are their return requirements? What's their risk profile look like? There's only so much supply of PTCs in the marketplace to go around. And so if every investor wants the PTCs, what's that do? It drives the price of PTCs up.
Right.
That lowers the investor's returns. And at some point, that's going to motivate an investor to say, okay, fine, the pricing might be too high for what I can accept on a transaction like this. What other types of credits do you have available? Then that leads to other types of tax credits. Eventually, it leads to ITCs. It eventually leads to FEOC tax credits. Or when I say FEOC tax credits, I mean credits that are basically subject to the FEOC rules. And so it's interesting to see how that sort of all unfolds over time.
I appreciate you pointing out that you can look at it at a really grand level of 2 buckets, but it's really all these different tierages of buckets and different risk profiles and all the rest. So it's not a homogeneous market or oligopoly market. It's a very heterogeneous market in terms of different niches and all the rest. So every player in some ways is unique in the roles that they're playing and they're evolving. And that's what makes the job so enjoyable. Is trying to help navigate investors, sponsors, and developers to the right mix of players and compliance to minimize the chance of negative outcomes.
Yeah,
So
and that's
speaking
where,
of that, go ahead.
yeah, and that's a lot of times where our financial modeling comes into play.
Yep.
Whereas developers and investors are trying to analyze the return sort of potential, if you will, or likelihood of different scenarios, PTCs, ITCs, just to transfer, et cetera, et cetera. And so we've developed these financial models that can run a variety of different sensitivities or different scenarios, if you will, that help the parties better understand whatever approach they go with, how that apt to impact their returns.
Right now, I appreciate all the great work you and the rest of the Novogradac team have done on the financial modeling side to try to help guide developers, sponsors, and investors to what's right for a given facility from a development perspective to make the project as financially viable and as financially solid as possible. Beyond financial modeling, maybe share some of the project valuation and the consulting services that we at Novogradac are providing to renewable energy participants.
Yeah, great. Thank you. I was just thinking about that before you asked. So I'll touch on the valuation side of things. You've heard me mention the 80/20 deals, the 80/20 projects. Again, that's like you got an asset that's been in service for a long time. Credits have already been generated and used. Now the asset wants to get a restart where they're going to buy new components and repower it. And if you do that in a way that complies with certain rules, you can qualify for new credits. A big part of that analysis is evaluation. And so Novogradac has a appraisal and valuation division that helps provide appraisals and valuations, not just for new builds, like for a new tax equity transaction, but also for some of these operating asset portfolios, whether it's a seasoned portfolio of operating assets or a portfolio that's looking to repower and qualify for tax credits all over again. And so that 80/20 analysis, just to refresh people's memories, the way that works is you've got a facility, it's been around for, it's got used equipment, okay? It's beyond its tax credit period, and you want to repower it. And so how you
Basically
do that is
renovate it.
you renovate it. And the way it works at the end of the day is when you're done with the renovation, the fair market value of the used components can't exceed 20% of the sum of the fair market value of the used components plus the cost of the new stuff. And so obviously you can see how an appraisal or valuations is a critical part of that diligence exercise.
Excellent. And I know there's a lot more consulting and due diligence and other services that we provide, but we can only go into so much detail in the course of the podcast. Any last minute comments you want to make before I bring us to a close?
I love talking about this stuff, Mike, but in the spirit of time, I think I've touched on enough.
Great. Well, thank you for sharing your insights on the current market environment and some of the factors shaping development investment decisions. We obviously weren't exhaustive. Please do stick around for the off mic section coming up shortly. To our listeners, I do encourage you to reach out to Tony for help with any of the services we just mentioned, or just any questions that you have. There's lots of services that we provide that you may need, and you can reach out and discuss what your needs are with Tony, and we can either help or provide some referrals to others. I also invite you to join us in just a few weeks at the Novogradac Spring Renewable Energy Tax Credit Conference in San Diego, California. That's going to be May 14th and 15th. I'll be there. Tony will be there. So please, if you do join, take a moment to come up and introduce yourself to me and introduce yourself to Tony and tell us you saw us on the podcast. We'd love to hear from you and meet you. I will include a registration link in today's show notes. It is a popular conference, so I do encourage you to register early and make your hotel reservations early. Also, if you're enjoying the podcast, please take a moment to comment on however it is you're watching the podcast. It helps others find us. Please also share with colleagues and share the podcast on social media. And if you're sharing it on social media, please share a link or include a link to me and to Tony in the social media. And with that, I'm going to turn to our off mic section where I encourage my guests to share an industry shout out. And it's always interesting when Tony shares the industry shout out because he is the one who got this whole industry shout out idea started. Kudos to you, Tony. Your legacy endures. What's your shout out this week?
Great. All right. So my shout out this week is to an internal Novogradac person, one of our partners, and that's David Boyster. David heads up Novogradac's renewable energy appraisal and valuation practice. And he's been doing more of these 80/20 valuation and appraisals lately, in addition to all the other appraisal and valuation work that he does for clients. And so I'd like to give him a shout out. And then as far as the conference goes, it's in San Diego. And I know what a lot of people are thinking. They're thinking that it's probably back at Rancho Bernardo, but it's not at Rancho Bernardo this year. It's downtown on the water. It's in a great location, super convenient to all the restaurants and nightlife and sightseeing of the downtown San Diego area. Super convenient to the airport and all that stuff. I love it. Novogradac's done other events at that same venue, and I love that location, and I think our attendees are going to love it too.
Great. Thank you, Tony. Thank you for the shout out. I echo your shout out. David Bush has been doing a wonderful job on the valuation front for our renewable energy and other clients. So thank you, David. And thank you to our listeners for tuning in to Tax Credit Tuesday. I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.